Master Trader Live. Simple market analysis and education to help you make money in the markets. Join us live each week on YouTube and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby.
Hey, good afternoon, everybody. Wednesday, Master Trader Live, day before Thanksgiving. Looking forward to it, of course. So today I'm going solo. Dan is on his way to Colombia to celebrate down there over the holiday. So we're going to cover some basic stuff, which is often, I wouldn't say overlooked. I think, well, I started out with the basic stuff, and after basically going to the moon around the planets and coming back, came to realize that it was the basic stuff that was the most powerful and relevant to making decisions based on technical analysis. And part of that trip around the planets revolved around all the type of esoteric types of analysis. We'll cover some of them. I'm not going to spend a lot of time on slides. You know, we typically do before I go to the charts, because it's those basic things that we really want to focus on. I'll cover them. Anyway, so as we spend time trying to figure out how to make money in the markets, we have a tendency to believe that it has to be or should be complicated because the markets are complicated. And in a sense, they are. There are a lot of different ways to trade, to invest, so many different, whether it's fundamentals, it's technicals, there's different ways of doing either one of them. So we tend to go through a long process of trying to figure out what's the truth. And so the truth for me came all the way back to the basic stuff that we're going to cover. Now, it's the combination of the basic stuff as it lines up that provides high probability trading and investing opportunities. Now, as we get into looking at multiple time frames, of course, that adds an element of complexity to what we're doing, and understanding that is a major component of operating and in the time frames that of our choosing. For example, someone in the green room today asked about a trade, a swing trade, and said, oh, is it okay? Like, are you still thinking this is a good trade? And what I said was, yeah, there's nothing wrong with it. And I said, if you're looking at the 5-minute chart, don't. And he agreed, kind of laughingly. He says, yes, I'm looking at the 5-minute chart, which tends to be irrelevant as it applies to a swing trade and will keep you not out of the trade, but typically giving up good trades too soon. So it all comes back to the basic stuff that we're going to cover and applying it to the time frames that we choose to. So for swing trading, that'd be weekly and dailies, sometimes the hourly. The monthly, at the end of the month, I like to look at them. Intraday trading, my time frames of choice are the 60-minute and the 5-minute. Sometimes I'll use the 2 to get a little bit more detail at certain times, but less is highly probable to being more when it comes to technical analysis, because we become overwhelmed with too much information and questioning different things. And as you look at different things, more questions come into what we're doing. So again, less will be more. And in addition, if you're looking at less, meaning different trade setups, different ways of applying it, it's easier to process that information and make decisions. Right? Not getting any audio here. Should be coming through. Let me move the mic a little closer. But how am I coming through? Okay, everybody says it's fine there. Okay, I did see the little mic moving there. Cool. All right, great. So, as I said, I'm going to go through a few slides, then I'm going to go to the charts. And if you take a leap of faith in what I'm going to share with you today and willing to reduce the amount of information on your charts, I'm telling you, the light bulb moments will go on. And when I say leap of faith, I know what it is to step away from what you believe. You believe is necessary because you've been inundated with complexity based on indicators, esoteric types of analysis, and so on. So when I say it takes a leap of faith, you have to be willing to remove that stuff from your chart and start focusing on what I'm telling you, test it, question it, and then see if the clarity comes and say, was Greg right or was he wrong? Or do you want to go back to what I'll call the training wheels, the indicators and trend lines and such. So, all right, let's get going here. So this is where you're likely to be coming from or going into this maze of technical analysis that you're led to believe is necessary. MACDs, MACDs, the difference between two exponential moving averages, RSI, CCI. I've long forgotten how they're calculated, but that's part of the process that you go through because look, unless you're just, and I'll take it with a grain of salt, an idiot, not to question what it is that you're risking your money on, and we all kind of tend to be that idiot at some point in time, you'll question, well, why should this indicator tell me that something is overbought or it's oversold or this is a turning point? So part of the reason that it takes so long to get proficient at doing this is all the different hurdles you need to get over of looking at what you're told and led to believe is necessary, to questioning those beliefs, to testing them on your own, seeing how these different things are calculated, what it's RSI, CCI, stochastics, rate of change, the MACD, and all the others, the hundreds of other things that are in there. It takes time. So the risk that you all are going to deal with is not focusing on the money at the beginning of those testing periods, because that's where the majority get knocked out of the game, or the profession is a better word to say. You get knocked out of the profession because you lose so much money and you just give it up. There's nobody can do this, right? So there's nothing wrong with testing, paper trading, doing with small shares. I don't care if you've got a gazillion dollars in your account, trading 50 shares or 10 shares, testing things out and so on is smart because you just don't know what you're doing yet. Action is awesome. Thank you. Someone giving me a nice compliment in in YouTube there. Thank you. So the other things, as you go from the basics, right, those indicators, those basic indicators there, let me just get these here, to getting a little bit more complicated, right? Bollinger Bands, Keltner channels, Ichikumi cloud. Like when I first saw that, I go, what the hell is that? With different colors and lines and all over the place. And I was like, I looked at it and questioned it. What is that all about? And I mean, I guess maybe that's just the ultimate indicator, giving you support, resistance, trends, so on and so forth. And so on. So John is saying he uses Fibonacci retracements and symmetry. Secondary analysis have consistent success. John, what I would say to that is if it works for you, go ahead and do it. And someone emailed me just this week because they said that they had a friend or a trader that they met that was using trend lines, and they said they were having success. And one of the things I said to him was, look, if that works for you to bring clarity to what you're looking at, it's all well and good, but you have to understand the price action and the subjectivity of those tools. So Fibonacci and symmetry is all that more subjective. But John, I will tell you, because I've studied this for years, because I also looked at that kind of stuff many, many years ago, is that if you just simply look to the left, 90+% of the time where those fib lines and symmetry and overlapping fib lines tell you to buy, you'll be in an area of price support. So for me, why not just look to the left and get the noise off of the chart? And additionally, what I said to them was, look, someone else that is successful using whatever it is, you cannot trade their mind, right? So whatever they're processing that they've come to understand by looking at the picture that they do, that's not in your mind yet. So just because they can make money doing it doesn't mean you can make money doing it. And you're going to have to work at that. And it's the same thing that I'm telling you here is looking at price action. You'll have to work at becoming proficient at doing that. And so to John's Fibonacci's and what the other fellow had asked me about the trend lines, I said, look, I use moving averages. They're subjective, but I realize that they are, and I do realize I really don't need them, and why I call them a visual aid, because I could take them off the chart and still do it, but it speeds up my analysis. Right? What Marcel said, I'm guessing, did Gibby's first 8-year-old, so there you go. Gibby has no children. I don't know what you mean by that, Marcelo. Anyway, so, and then it gets a little more complicated. Market profile, which is just looking at support or resistance, and it talks about a bell curve and being out of the bell curve, right? Where something has gotten out of support or resistance to fade that, and points of control. And, you know, it starts to become a mind bender for sure. On balance volume and distribution, volume indicators. Why not just look at the volume bars? And Fibonacci's, right? Extensions, right? Someone had asked me, what's your target for the upside of the market? I was like, I don't know. It's making new all-time highs. I said, when it stops going up, we'll all know it. It'll break some support. There'll be some event where things come down. We don't need to catch the high, right? You all heard the saying, you know, I want to get the meat of the move. Of course, time cycles. Wow, that was a trip, you know, 25 plus years ago, you know, with time cycles and the fib cycles into the future around a full moon or a full moon and what is it, the new moon, and how those things would line up. It gets really crazy with all of this stuff. And then, because trend lines, Elliott wave, square of 9. I mean, no wonder the failure rate, and you know, you pull that number out of a hat when people say 80%, 90%. After you've gone through this maze of information, VWAP, my God, you know, just another way of looking at support or resistance. After you've gone through everything that's on here or part of it, good luck trying to get to the other side of it. So let's move on and, you know, get through this, and even, you know, as I said, give it a test of what I'm saying. So just to go over this so you understand it, trend lines, right? What are they trying to do? I mean, this is something that, of course, I studied that as well. I drew the trend lines. I questioned, do I touch the tails? Do I draw it based on the closes? And why in a situation like this, why did it break the trend line and then reverse right back up again? How is it possible to break this trend line? And it's kind of silly. I kind of laugh at it when you see the guy on CNBC with his finger across the trend line, right? And saying, oh, this trend line is 3 years long, and if it breaks, right, it's over. And then if you go back and look at it, maybe it broke. And so that kind of twists you as to believe, that enforces that belief. But what does he do when it breaks, like here, and starts going up again? Well, just draw a new trend line and a new trend line. Right? So there has to be a better way, because this is very subjective, right? And if you just, well, we'll get to it. But anyway, we just look to the left and see what the trend is, and understanding multiple time frames. You don't need to connect the dots, so to speak, right? So here's another trend line, and it breaks, and buyers step up again, right? Where do they step up? Well, where they stepped up before. And another break, but did it actually violate the trend? And so it goes on, and then people start drawing channels like this and connecting dots. And I've seen people draw lines where, well, on the chart where there's lines all over the place intersecting each other. And then they draw lines after the fact, meaning just to show that it broke. Again, as you go to these different webinars and see the different indicators and the trend lines and the fib lines, you know, trying to get through the other side of that maze can take years and years. So if we can hopefully get you beyond that with a shorter period of time of looking at this kind of information, I think we've been a success. And so again, how many times have you thought that this doesn't work, but you're still doing it? This is the crazy part about what we do, because as we are learning and using these things that we've been led to believe are true, and we start to question it, as I did. Yes, John, I've heard of the squeeze, which it's actually, okay, so I'll share a little history to you. It's actually created by someone in the TradeStation forum, John. And actually Hubert, who used to be his partner, found it, and who's a pretty good marketer, I suppose, went and called it by their own company name when they used to be partners, right? Which was Trade the Market, used to Trade the Market squeeze. But actually, if you search the forum on TradeStation, you'll find out the person's name that actually created it, right? Which is nothing more than saying volatility is contracted, so let's assume that it's going to increase, right? So you had higher volatility, wide ranges, the ranges come together, ranges might spread apart again. That's all it is, right? So insanity, doing the same thing over and over again and expecting a different result. So as I did, and I drew these lines for years and questioning, why doesn't it work? Why didn't the trend actually end? Maybe I needed to look at the higher time frame. Well, why didn't it work there? Why did it work sometimes? And so on. Bollinger, I think Jerry may have called it a squeeze at one time, where the bands, you know, they come together, right? Again, if you can see, if you can just look at a chart and just saying, well, it was doing this, and now it's doing this, volatility is contracted, and it may break one way or the other. So there are ways of coming to a bias as to which way it might break, like multiple time frames, relative strength, relative weakness, what's happening within the sector. All of those additional pieces of information could put the odds in your favor, which builds upon the basics that we're covering. But all of this trend line drawing and bands and squeezes is nothing more than you trying to filter, right? Or having some tool, if you will, filter what's right there on the chart for you to see. You just need to understand how to see it, which is what we're doing here today. So what most people believe is that you need to have some complicated or proprietary indicator to massage the prices to allow you to understand what's happening on the chart that's right in front of your eyes, right? Now, looking at that indicator, whatever it is, you'll see at times it's not going to work, which intelligence says, hey, why didn't it work? Now, you might try and tweak the settings. You might move on to another indicator. You may buy the latest, greatest indicator with the improvement, right? The upgraded one that now is going to filter out those false breakouts and breakdowns. So that is what you are up against with that type of marketing. And I've already warned you that, you know, the process that you're going to go through with doing that. And This just is what it is. So looking at what I've drawn here, this stick figure, I'm saying, would you agree that this is an uptrend? Yes, what Ian is saying is that what he's learned from my swing trading course, that indicators are good for scanning, and they absolutely are, because it's easy to use an indicator as a filter, like ADX, trend strength, and so on, to put that together. So yes, it's an uptrend, right? No ifs, ands, or that's about it. Higher highs and higher lows, right? So guys, give me 1 sec here, please. Okay. Higher highs and higher lows. Has the trend been broken? So this is how the fella on CNBC is going to show you, oh, the line was broke. Well, did it violate any support? Did it? Right. No trend break. It's a deep retracement, which is what you really are interested in when something is in an uptrend like this, and not based on Fibonacci. The deeper it retraces to the prior low, the more questionable the trend. But a break of a trend line doesn't necessarily break the trend. And for example, if we had a trend that was accelerating far from support, let's say there was a shallow retracement, and now you draw whatever, you could break a trend, and I'm not drawing this exactly right, but point being, you can break a trend line and not violate any support whatsoever when things begin to accelerate. Right, so here, it's broken. Is it? No, it's a normal correction. Now, this example, right, you can clearly see that it's violated the area of this swing low right there. So knowing that, if we just say, well, if this low, my little spotlight out here, if this low, which we're going to define, call major support, that low prior to the higher high is violated, it's no longer in an uptrend because it's violated the definition of an uptrend by making a lower low. And the simplicity of that allows you to remove this. You don't have to draw it. You don't have to be confused about trend lines and did it break the trend or not break the trend. It broken. It traded below it. Now, as we're not going to be able to get into multiple timeframes today, but I'll just share with you, the question is, let's assume that we're swing trading or looking for swing trades, and we see a violation of the daily time frame. Let's assume this is a daily time frame, and the weekly time frame is still an uptrend. I guarantee you that's what's going to happen in the market, right? You know it is. At some point, it's going to violate the trend on the daily time frame, but it's not going to violate the trend on the weekly time frame. So understanding how to put that together and then waiting for, let's say, a bottoming pattern on the daily time frame is going to be your entry point to continue the higher time frame. We'll see that happen, whatever, next year, I suppose. So let's talk about indicators. And I've just used simple stochastics here and a MACD because it's pretty common indicators. We're looking for overbought, right? What's supposedly overbought is supposed to pull back, and well, it doesn't pull back. So this move off of this low, right, was a pretty powerful move. Straight bars up, which they took out this prior swing high. So clearly a violation of this downward trending move, which suggests it should continue to go up. Another overbought. And so as it pulled back a little bit, doesn't mean that it had to even pull back a lot or at all. It could have went sideways when this was up here. And now we've got a MACD sell signal, and you've got this little histogram down here, which looks very nice as you put it all together, kind of the chart artist situation. And now it doesn't get oversold over here. So what do you do? Well, if you're like me, 25 plus years ago, you figure, well, I had the wrong settings. So I tweaked these, and now it's oversold. And now I go into the future thinking, well, I've really got it locked in now. And then it doesn't work on the next stock or even on this one or the market that I'm looking at. So what do you do then? Change indicators, change settings. Well, I thought, as I learned more, I was becoming smarter. So now I created my own indicator that now took into consideration multiple time frames at the same time. And I thought, I really got it now. All right, this one is going to take into consideration different time frames at the same time. So it's not going to give me any false signals. Wrong. Right? The thing is understanding the price action and getting this stuff off of the chart. And that is what brought clarity. So this is what is referred to as that Ichikumi cloud, right? And so I say to you, are you ready to stop the craziness with all of this noise? Because there are times where something like this, you can't even see the bars through the mess. But nonetheless, there's probably some of you in the room, and there's a lot of you that probably have used this, using it, maybe paid for an optimized version of it with all the little pretty colors and so on that came with some package. And then when it stops working or it doesn't working, you'll look for another indicator, and it becomes a vicious cycle of going down the rabbit hole with these indicators. And as you build that, and maybe you're drawing fib lines on top of the Ichikumi cloud and trend lines and thinking about cycles. And before you know it, you're going to be explaining to your better half how you lost all your money. Right? And it's demoralizing, because this stuff, sometimes it works and you see the examples of how it's so perfect, and it leads you to believe understanding of this. So for you, what are the basics? I'm going to get to that, Susan. Kind of like got to build up to it a little bit. We've got time. I'm going to look at some charts. Be patient. I'm not going to leave you out of here without telling you. All right. So here is basics. And I'm not telling you something that you haven't heard before. Support and resistance. But none of us, we believe it at the time when we hear that it's that simple. So uptrend, higher highs and higher lows, sideways trend, relatively equal highs and lows, and a downtrend, lower highs and lower lows. So I told you, major support, the low prior to the higher high. Minor support is the high that it exceeded. In an uptrend, the assumption is that it's going to take out that high. All right. So yeah, guys, I should have said that. Dan usually is really great about saying it. Please change your drop down to all panelists and attendees. Yeah, versus just sending it to me. You're welcome to share your thoughts with everyone. We don't hide from comments here at Master Trader. So what was resistance should become support. What a revelation, right? You probably read that in one of the first books you ever picked up, right? Maybe Technical Analysis for Idiots or something like that. I don't know. It was one of the first books that I read probably 30 years ago, but wanted to believe that I needed fib lines and cycles and so on and so forth. So as prices pull back, right, to the green line, it's horizontal, minus support, buyers should step up there. But if it pulls all the way back down to major support, that's a deep retracement, and buyers should be there as well. But it puts the trend in question because of the depth of retracement. And obviously, if it breaks down through major support. It's no longer in an uptrend. Now, a little bit of advanced thoughts here, meaning, how does it break major support? Meaning, did it break it like this, right? Or did it break it like that? You see the difference? I mean, it fell like a bag of rocks off the roof. That's powerful. Versus it kind of just drifted down over a longer period of time to take out that low. So the difference there is that the drifting one has a greater probability of survival versus the one that dropped off the roof, right? Common sense. But we look at all of these different indicators that are going to tell us the speed at which prices move. And I get passionate about it because I spent a long time trying to get through all of that BS. And so downtrend, lower highs and lower lows, right? No trend lines needed, no fib lines needed, no moving average crossovers and whatever. It's in a downtrend. And what was support, right, should become resistance, and over here and so on. And it just repeats. I like to call it factory work. Right? The one that dropped off the roof created a big void, which may be a long opportunity. Very true, Pat. So, however, is it a long opportunity in the time frame that it dropped on, or is it a short-term opportunity to trade against that big drop into the void in a lower, from a shorter point of view? Well, Randall's saying he would short it, but short it when? On any gap ups. Okay, that makes sense. All right. So what Pat was saying is, when it drops like that, it creates the void. You know, guys, Pat has been with me for a couple of years now, so she's at a little bit of an advantage over some of you that are new. And so when it drops that way, it can have a little bounce. But when it does drop, the damage has been done. So you're waiting, right, to test what was support to become resistance and short it at that point, ideally. Or with advanced money management, you could short it almost at any point in time, what you may think is crazy. But if you give it a big, giant stop with smaller shares, you can do it. Money management provides flexibility to what you may believe is necessary of exactness, which is what trend lines and oscillators and fib lines and extensions and squares of 9 and all that lead you to the belief of being exact, right? Being exact in today's market environment of algorithms and so on is like 1,000 razor blade cuts, right? Exact doesn't work like it did in the 90s, right? You have to be more flexible today, and money management, which is always important, becomes even that much more important. It just allows you to not need to be exact, right? But that's a whole nother conversation. All right. So this is the void, right? What Pat was saying, there's a void. And what is a void? Everybody, what is a void? Well, it's nothing more than a momentum move, or it could be a gap. Someone's asking me in YouTube about offering deals for credit spread, debit spreads, and Iron Condor subscriptions. Yeah, Hayward, I'll show you that in a second. It's a big move, a momentum move. So when prices move with momentum, and that could be a big gap or a sharp move like this, there's nothing to trade against. Meaning, if you said, okay, something's in a downtrend and I want to short it where it broke down from, price resistance, well, there's nothing there. And this is where you really get your head handed to you with the fib lines, because you're led to believe by connecting dots, highs and lows, that some mystical golden ratio is going to tell you where the resistance is. Let me just say bullshit. Okay. And then when you get into drawing fib lines from this line to that low and this dot to that low, and you start getting into the overlapping fib lines, and John said symmetry and all that, eventually you will go a little out of your mind trying to figure that out and drawing all of those lines and so on versus just looking to the left. So what do you do, right? So I'll get a little bit of an advanced type of concept. What do you do if something is in a downtrend like this? It's sharp and maybe it broke from a base. How do you jump on board? Jump on board intelligently, right? And I'll tell you how I do it. If it just starts, it's either going to be what I call a correction bar, which could be nothing more than, let's say, a green bar up and a red bar right back down again, or a topping tail that happens from the beginning of the move, or it has to be a retest pattern. If it doesn't do one of those things, it's leaving the station without me. That's the trading plan. I need either a correction bar continuation pattern, or I need an M top and a downtrend, and it's still got a void below that it keep dropping. And you might be saying, well, what about this low, Greg? I know it's there, but because it's in a downtrend, right? It's pointing down. My assumption is it's going to take out that low. Whether it does it or not, I don't know, but that's where management comes in. How will I be able to manage that? So position and money management is another part of your trading plan to adding to the basics. Right? All right. So we're going to go to some charts here. And someone obviously asked about, are there specials for credit spreads and debit spreads and so on? Yes. Type in this URL and it'll take you to a page. And in one of those pages, there's a link that leads to other pages to whatever you might be interested in. Swing trading, options, credit spreads, newsletters, and so on. There you go. The green room, which is, again, it's holiday time. We always have those specials. So let's go to the charts here. Thank you, Pat. All right. Stop that and share. And all right. So I got one chart here. I've got the diamonds up here, and I can look at anything that you may want to look at, but let's just start this and covering with basics here. Right? Clearly, this is in an uptrend, right? And so the dots here, right? This is just marking a swing high and a swing low, which we have to define, right? To have a trading plan, you have to define everything. How am I going to do it? How am I going to interpret what I'm looking at? How am I going to trade it? My money management and so on. So I had to make something up here, right? Which could have said, well, which was that swing low and that swing high is a bar with 3 lower highs to the left and the right. And this one has 3 higher lows to the left and the right. And so intelligently, you might question me and say, well, Greg, why not 4? Wouldn't that be better? Well, theoretically, it would be a stronger reference point, but we have to make some choices along with what we do. And 3 works really, really well. Right? 2 can work, but the relevance of 2 versus 3 is going to be less. And again, I don't want to be looking at too much, right? So for example, this one here, if I was marking it with 2, it would show that as a swing because there's only 2 to the left. There's a whole bunch to the right here. But I know in a smaller time frame that this one here is a swing low on probably an hourly chart. And so as you train your eye to look at this information, you recognize that, and you just simply look over to the left and you say, well, this is an area. This is an area of support where buyers should be. So as prices dip down into that area, excuse me, buyers should step up there. How do you know when they've stepped up? Well, the individual candle that forms, the bottoming tail bar says they stepped up. Well, all right, here's a little off track here, but what if you want to buy the bottom of the bottoming tail bar? Would that be of interest to you? It depends on the time frame you're trading, right? If you're an intraday trader, sure. How do you do that? You go down to smaller time frames and you apply the exact same thing. Is what I'm saying is, first you start with a higher time frame reference point and you say, well, when it gets down there, I'm going to use a 5-minute chart to tell me that buyers are stepping up. And you might say, well, Greg, my overlapping fib extensions and symmetry and so on and so forth suggest that that area is where I should just buy, and I'm going to bid down there. I'll say, more power to you. Go ahead and do it. It's just a different style of trading, but your lines are going to line up with this support area here. And then there's no way of knowing whether it'll just dip down under there and spring back up again. So why not wait for a bottoming tail bar or a retest pattern on a 5-minute chart? These are choices, right? These are choices, right? What are the MA specs, Raj is saying? They're just simple moving average, Raja, and you can see right here a 20 period, a 50 period, and a 200 period. And they're simple. If you want to use exponential, you can. I've just found the simple version works really well, especially on indices. If you're trading maybe Forex, maybe exponentials would work better since more people are looking at them, but this works. You don't need a 100. I know it's in between here. I don't need an 8. I don't need a 10. Again, the price action I'm focused on. So when I look at this picture, I've got a rising 20. I've got a rising 50. And I know the 50 is the same as a 10 on the weekly time frame. So I know the weekly time frame is up over here. And that 200 is equal to a 10 on a monthly. So the monthly is up. And I know that by looking at these 3 moving averages. So I'm not having to look at 3 different time frames unless I choose to. So this one time frame tells me that I've got 3 time frames in alignment with each other. Simple. So this is moving up. Momentum is stalled here today. I spoke about this pre-market. Is that the greater than 100% retracement concept is one in which it says after it takes out the prior high, look for momentum to stall. That's all it's done. Tanya's asking, could you please point to 3 higher lows that you refer to on both sides to define a pivot? Sure. See the green dot? There could be 12 to the left and 12 to the right, Tanya. But what it's saying is, at a minimum, there has to be 3. Right? So if there were only 2 to the left, like this one, because this is lower, right? It's below this one, so it's not marked. If I said, show me the ones with 2, then it would mark this one, right? But it has to have a minimum of 3. So with that, once it pivots, right? Once there was 3 here, the software marked a dot there. Now, once it traded above the high, right? Which I said, once it trades above this high, this low becomes what I showed you on the chart as major support. Once it exceeds this high. So if it trades below major support, it's no longer in an uptrend, plain and simple, because the depth of retracement was too far. However, when it gets down here, buyers have the opportunity to save the situation. Sometimes prices come all the way down. Right? You see, this one came close to this support here, and then price came up. So deep retracements don't end the trend. Buyers are still going to step up there. But if it slices through that like it's not there, That's bearish, right? So let's just kind of fudge it here and just say, for whatever reason, right, China comes out tomorrow and says, you know what, screw Thanksgiving, we're ending this deal. Tell Trump to go to hell. Well, Friday morning, slam right down through here and straight down versus, let's just clean this up for a second. It just kind of drifts. It drifts down here because everybody's on holiday and it comes down here. That's very different on how it retraced here versus slamming down. So when it hits the 50, because institutions are following that, it's probably going to bounce. So what Pat was referring to, well, if it crashes down and creates this void to a reference point, which is pretty much in alignment, we know we're dealing with the unknown, but we have to have a plan. Factory work is, if it was to do that and retraces up here, think to be a seller and look to short with the appropriate candlestick pattern, right? Which could be an M top, it could be a topping tail, it could be a bearish 180 reversal, right? So we've covered lots of different candlesticks arrangements in different MT lives. So whatever one forms, right, bar by bar analysis will tell me this is what's happening in the moment at a prior location. All right, so let's look at something else. What about pricing for green room? Jake, it's on that slide, right? Not slide, it's at that URL. There's a thing for green room, which you'll never see that price again until next holiday. So you can check that out. I mean, the prices that are there, folks, are great. Those of you that are already in the green room and paying month to month, I mean, the price for an annual at that price is ridiculous to pass up. But anyway, it's another conversation. All right, so let's just look some other things here. Just pick something out of a hat. I saw this was in the news the other day. This sporting goods. It was a major breakout, right? So I could either squish things up here to look to the left, because once prices break out, as this did, I want to see where's the next reference point, which is up here in this area. So that gives me, kind of guidelines as to where this might go. And here, $50 is a whole number, but that's a pretty bullish breakout. Now, rather than squishing up prices, I could have went to a weekly time frame, and I'm going to see the same areas here. So this is the concept of a void, right? The big drop, and years, right? Like 2 years of sideways price action and the breakout. So that's a bullish chart. So now we need to see a continuation pattern. We need to see some kind of consolidation. And the assumption is that it'd be going higher. Let's look at a few Dow stocks. How about that? By the way, this platform is the best, and I have no affiliation with them, but it's the best for scanning. It's great because it automatically, as you type in a sector or an index, it puts the stocks for the majority of them in a minder for you over here, which many years ago you had to do that yourself. It was laborious to go look it all up and create it. So the Dow stocks, it's got a void, Visa, it's taken out the high, but look how right at support, right at the prior support, buyers stepped up there. Now it's going higher. My assumption is, until proven otherwise, it's going to keep going up. How do I get on board? A continuation pattern, or I can intraday find an entry point using the same analysis. And again, the choices, do I do it on the hourly chart? Right. See, this is bullish price action right here at this prior swing high, sideways at a prior swing high, tells me that buyers continue to step up after the move. So a continuation pattern. It should keep going higher, right? And now, so hourly time frame, you want to drill down to a smaller time frame, you could do that. So what we've done is simply have formed a bias based on a daily time frame. Now, what if this runs straight up and you don't get a continuation pattern? It happens. Nothing you could do about it, right? If you don't trade intraday time frames, and that's a choice, you don't have to. It's okay. You move on to something else. Here's Disney, right? Explosive move, bullish price action. It's continuing higher. How high can it go? Look to the left. Oh, there's nothing there. Take a guess. I don't need fibs, right? We don't want to get into that, but could it go to 200? Of course. Who's to say where it can't go? So now follow the trend, right? That's not a pivot, but it's a base. So clearly it should keep going. So if this can go sideways here for a little while, and I would love to see this, one of these continuation patterns, like I'm trying to draw this here. Let's do it this way. Let's say that we got a gap down and reversal, and this was actually green. Buy it above the high, put a stop below the low. Bassem saying, I hear you sometimes saying it is overbought, oversold. How do you make that statement? I don't think you hear me saying that too much, Bassem. What I will say is it's extended, right? If I've ever used that term, that's what I actually meant. It's extended, meaning it's moved very far away from a reference point of price support. So this is not extended on this time frame. It's not extended. And I have to switch back and forth here. Right? It's close to support. And this created an area of support. Right? It created that support. Do your class multiple time frames, and when volume is bullish or bearish, how do you identify continuation patterns? Well, I just showed you one way of doing that is to just say, I'm trying to draw this here. It won't allow me because I'm too close. So I'm just on top of that, but you get the idea. A gap down. It may, if it had a down day, and it formed a bottoming tail bar. So one of the things that I wanted to do is to take out 1 or 2 bars lows. And then from there, I want to see it spring right back up again. In other words, it tells me that there's strong demand and buyers are lurking below. Who are those buyers? Mutual funds, big money. Big money is lurking down there. That's the only ones that are going to buy a gap down and turn it into a green bar or a nasty sell-off, which will look nasty on a 5-minute chart or maybe an hourly chart and turn it into a bottoming tail bar. And it seems that big volatilities are above 145, George said. I don't know what that means, George, honestly. Big volatilities above 145. So I look at things in a really, really simple way, guys. I look at a big green bar and I say to myself, you know what? It should stay in the upper half of the green bar. Said that this morning, pre-market. Why? Because typically you don't get retracements that deep when you get a big wide range bar. So I want to see it create support. And that's what it did. It tried to dip down and it turned back up again. It's not a bottoming tail bar, but it's what I call a 180 reversal. It's the same thing as a bottoming tail bar. And then it got a little tighter. All right, so let's go back to your idea of a squeeze of Bollinger Bands. Big range. Ranges got smaller. Ranges got smaller. Do you want me to create an indicator and sell it to you for $500 that tells you the range got smaller so that you could understand that this is contracting in range? And because the trend is up, look at the moving averages and the price action. I can create something for 500 bucks and sell it to you, but I'm not going to do that. I'm telling you that just simply looking at this and saying the ranges are getting tighter and the trend is up and there's a void above, that it should continue to move higher. How would you adjust your position in this case above 143? Well, is 143 relevant? I don't know. By the way, I do appreciate the questions. And so 143 is kind of irrelevant, I guess, where I put that line, the halfway mark. So once it clears this highs, just think to yourself, George, what shouldn't it do? What would make you question your bias that this would go higher if you were long? That will lead you to the answer, right? So how far away do you want to make it? So let's call it 143, but this reversal is meaningful because it dropped down, it came up, it went sideways at resistance, the topping tail, and it continued higher. So if I want to share size this under here, right, less shares with a bigger stop, that would make a whole lot of sense. And then if I was to get a continuation pattern, as I just explained, the breakdown of the gap reversal, I could add to it and bring my stop up. Does that make sense? Now, if I went down and I said, hey, I'm now going to share size this, and rather than this point, and I'm now going to share size it here, that could work, right? That consolidation. What if I said I'm going to share size it under today's low? You're probably going to get chopped up, right? So the tighter you get, the more the probabilities are of getting stopped out, right? On a wiggle, right? Now, as this is pulling back to support and you're an intraday trader, and this is what's coming next year that I'm going to develop this course, is to say, hey, I've got this bias based on these higher time frames. And now it's bottoming out here, and I'm going to buy the pullback to what was resistance to become support, and I'm going to put my stop under here and share size it for that. And because the markets are moving up, let's assume we're looking at the market and so on, I'm thinking this can go back up to the high of the day. That's a trading plan, right? Or this could be a continuation pattern, a red bar ignored, right? Do you trade from a 5-minute chart? It's a choice, right? What is the criteria? Frenchie's asking me between the red and green dots. Really simple, Frenchie. There's 3 higher lows to the left and 3 higher lows to the right. There's 3 lower highs to the left and 3 lower highs to the right. It's going to be less relevant on a 5-minute chart than it is on a daily chart or an hourly chart. It's just basically telling me where there's been a swing based on that really simple criteria. James asking me about Beyond. Dan mentioned this in the room today, where that it looks like it's finally catching a little bit of a bid after coming all the way down here, right? Where is it? Down here at this support level. It's closed the void, right? It's come all the way back down. And now, right, this is the concept that's called creating support. How do you create support? Well, you form a pivot. What is a pivot? You see where this is going, guys? How simple it is? I'm trying to find my drawing tool here. Yeah. All right. How do you create a pivot? 3 higher lows to the left and right. Right? It broke that one. And now it broke that one and it formed a new one. And it came back up to resistance. This is what we call a downside shakeout. It's a short-term bullish pattern that suggests a bottom. So this is created support, right? Where it was to the left was so far away. So now, see the dot, the swing? It stalled there. Why did it stall there? Because that's where sellers were before. And so if we go to, let's just pick a 15-minute chart, right? For whatever, it doesn't matter. Right? Lo and behold, You look to the left without any fib extensions, without any squares of 9, without any stochastics and so on. There were sellers up there where they were before. Wow. Right. What a revelation. Prices trade between support and resistance, regardless of your squiggly lines or your fib lines or your extensions and so on. Right. Take the craziness off the chart and look at the simplicity of what is directly to the left, bar by bar analysis, creating support and resistance and so on. So could you review the basics for intraday trading? I could, Susanna, but we're at the end of this MT Live, but all you have to do is apply it exactly what I'm telling you. Just choose different time frames. I said that an hour ago. Right? So rather than using daily and weekly charts, start with a daily chart of a bias and look at a 60-minute and a 5-minute chart for a little extra X-ray view into what's happening. It's really that simple. This could be very good for an Iron Condor, John. Yes, right? Selling a spread above here and below here. So with spreads, it's always about, is there enough premium above and below, right? So, you know, as you go through your patterns, right, you look to see, okay, I've got a pattern now, is there premium? So I looked at this morning. And so the support being down here, I said, well, is there any premium? You know, even I think it was 9 or 10 days out, there was no premium down below here. So, you know, wasn't there. As you go further out in time, you know, you're taking on more risk for that extra time and you're getting that premium, but you got to hold it longer versus, you know, we love in the green room to find opportunities, which we finally call one of the subscribers in the room, McGraw, Trader McGraw, because that's his favorite setup. You know, 0 days to expiration, Monday, Wednesday, and Fridays. And, you know, virtually, well, there's not no risk, but limited risk in SPX because it expires that day. So we just did the same thing, apply those patterns. Lastly, someone asked about gold. And so gold had a nice pop yesterday. And this is the same idea of creating support here. So it gapped down today as the market gapped up. This had this inverse relationship. So now going into, well, even Friday or next week, if it can clear the high of this bar, it's a buy. Even though this is in a downtrend here, it's trending down. This is an example, what I told you before, of drifting, right? It's drifting down to this support point here. And now we've got this W kind of pattern. Can it clear that high? So that's what I'm interested in, because look at this monthly time frame. Multiple year consolidation and a breakout with a void. And it's drifting down into support. Now, maybe it breaks lower next week and comes down to here. I don't know, maybe it will. But down here, I believe that there's going to be big buyers, and look at the 200 in alignment with that. So we'll see. Can it clear this area and now pop up, or is this going to fail? Right? If this fails, that opens up the door to potentially coming all the way down here. Okay? So with that being said, guys, I've covered a tremendous amount of information here with all of you today. And somebody is sending me some messages here. Anyway, until next week, you want to know more about Master Trader, check out that link that I sent there to the specials. Join us in the green room, the letters. We text you every day. And by the way, all of my indicators and scans, they come with the membership to Master Trader.
Thank you for listening to Master Trader Live.
Bye-bye.
If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.